Hello everybody, welcome to Accounting 341. This week in 341, we're going to look at My Educator 6 and 7. Mostly you'll be looking at that. My advice on this is to do those smaller exams. For instance, on 6, there's two, call them practice exams. Do those as well as the final, and that'll help your grade. The finals exams on 6 and 7, for some of you might be a little more challenging. If you get 100 on 6 final exam and 7 final exam, don't worry about doing those smaller exams. But if you have difficulty on the final exam, I would suggest doing those smaller exams. We're going to talk about problem 12.2 at the end of this PowerPoint. There's also a discussion board about controls in the revenue cycle that you'll need to do and need to be invested in. And then the revenue cycle lecture, which I'm going to talk about right now. So the revenue cycle, this is chapter 12, is a recurring set of business activities having to do with sales. So the selling of the product, picking of the product, the shipping of the product, collecting cash for the product. The objective of the revenue cycle is to provide the right product, right place, right time, at the right price. To do this, we need to be successful in many key decisions, such as how much credit should we extend to customers, how much inventory should we carry, should we use GIT, how should we deliver merchandise to customers, so forth. There are three basic functions in the revenue cycle: capturing and processing data about business activities, so documentation about business activities such as a sales order, and picking tickets and packing slips and so forth. That documentation is the way that we collect data. Then we store the data in a database, Access or other relational type of a database. And then for the accountant, maybe the most important part, the accountant and the auditor, would be to provide controls to ensure reliability of the data and to safeguard our resources. Within the revenue cycle, there's four activities. There's sales order entry, shipping, billing, and cash collections. So sales order entry, we take the customer's order. Now, a lot of times that'll be done on the internet. And so that's probably better for accuracy and saves us time and be more responsive to the customer. Checking and approving customer credit, and that should be done by someone independent from the salesperson. That's the separation of functions. Check inventory availability, and then respond to customer inquiries. So when taking orders, you can do it nowadays. A lot of it's done over the web, but we can do it over the phone. Someone can come in our store. We can have a field rep, a sales rep that'll take our order for us. Electronic data interchange is used so we can look at our orders, follow those orders closely, and allow vendors, if we want, to manage our inventory. So that's just a choice that a company will make, but sometimes the vendors will decide when the inventory is delivered. Now, that being said, that you need to have controls over that, because the vendors may be selling you more than you need, and then you're carrying inventory, and that's costing you money. All right, and credit approval is the next step in the sales process. Normally we have someone independent, a credit department, that will do that for us. Each customer normally will have a credit limit. A lot of times if we're using an ERP system or an advanced system, that the credit is going to be automatic. So if someone is current on their debt, they pay their bills appropriately, and they're below the credit limit, they're automatically going to be approved for the sale. It's only in situations where we need a credit manager, where it might be someone's a little bit over the limit, they might decide to make that limit a little bit larger. All right, so once credit is approved, we'll check inventory availability. If the inventory is not in stock, we'll initiate a back order if the customer wants us to. Now remember, if inventory is not in stock and we do a back order, now we're relying on our vendor, and maybe several weeks, maybe 2 weeks, 3 weeks before those goods are in. So we need to notify the customer that, hey, it's going to be a back order. It's not going to be when you want it. It's going to be maybe a little bit later. And so they're a JIT company. They may not decide. They may decide to go with a different vendor. All right. Once the inventory is available, then we'll go ahead and create a picking ticket, and it'll be picked from the warehouse. Instead of using a picking ticket, some companies will just use a sales order, just as an aside. Of course, the accuracy of inventory records is very important. That we have something in stock, but we issued a back order for it. Now we're not as responsive to the customer as we could have been, and the customer's upset because he didn't get his goods as quickly as he should have. We do need to be responsive to customers, and we do this through our salespeople. The salespeople is usually the point of contact for the customer. Some companies have what's called a customer relationship management system. It's basically a computer that will allow us to have better relations with our customer. A good example of that would be OnStar. So you'll get an email from OnStar. It'll tell you that you need to get an oil check using GPS information. It'll tell you need an oil check, or you need to get a tune-up, or you need to get your battery service, those types of things. All right, so the objective and goal of the CRM system, of course, is to retain your customers, retain as many customers as possible. All right, other types of technology other than the OnStar CRM management that can help with responding to customer inquiries. POS systems are great because they automatically update inventory, and they also can link with our customer master file, so we can see what customers have purchased from us in the past, and we can see whether the inventory is in stock or not. All right, the next step after picking the inventory will be to ship it, and that consists of 2 steps: filling the order, so picking and packing the order, and then shipping the order to the customer. So the picking ticket that we printed out can be used to fill that order. Technology that's used at this point might be RFID to update inventory. So we pick the order, the inventory is leaving the warehouse. If we use RFID technology, we're not going to be accurate in the amount of inventory that left the warehouse. Once we go ahead and pick the inventory and pack it, we'll go ahead and ship it. So the picking ticket will be used to indicate physical quantities of the goods that will go into the box or boxes. Packing slip will go to the customer, and that will list quantity and description of items shipped. And the bill of lading is your shipping document, legal contract that defines who is responsible for goods in transit. Normally, by the way, the person that pays for the shipping is the person that's going to be responsible for those goods in transit. All right, bill of lading can also serve as a freight bill if the customer is paying for those shipping charges. One big decision that needs to be made when we're shipping goods, of course, is how we're going to do the delivery. So it could be digital, but if it's physical goods that are delivered, are we going to use a third party like Amazon normally uses UPS most of the time, or are we going to ship it ourselves? Do we have our own freight of trucks, or our own group of trucks that we can use to ship the product ourselves? All right, and billing, 2 tasks: an invoice, which is the bill itself, and then updating accounts receivable. All right, and those should be done by separate areas. We have a billing area and an AR area. All right, for separation of functions. 2 types of methods used for billing: open invoice method, where customers pay according to what's on the invoice. So if you buy 5 things in one day, you buy something at 8 o'clock, 10 o'clock, 2 o'clock, 4 o'clock, 5 o'clock, you're going to get 5 bills using the open invoice method. When you pay the bill, you'll cut off a piece of it and use a remittance, or you could pay it electronically. All right, but you get a bill every time you buy something. The balance forward method is like a credit card, is that every time you buy something, it adds to your statement. So at the end of the month, you get a monthly statement. You bought 50 things, and you spent $5,000. That's the amount that'll be on that statement. All right, one advantage you might think, is there any advantages to using this open invoice method? Because it seems like it's a lot more bureaucratic, a lot more paperwork, which it is. But one advantage is that it can lead to an easier offering of discounts for prompt payment, because every invoice is individually tracked and aged. A disadvantage of this system is that it's more complex and there's more paperwork involved. The other type of approach is cycle billing or statements. Monthly statements are prepared for subsets of customers. You don't want to send all your customers their bill on the same day. You want to send maybe A through E, week 1, F through J, week 2, and so on and so forth, so that we have a little bit more even cash flow throughout the month. We may have some problems with collecting account receivable, so you may need to write off that account receivable. When you write off an account, it has to be authorized. So normally the credit manager will authorize the write-off of that AR. There'll be a credit memo, and then we can go ahead and write that account off. But it must be authorized by AR. Cash collections. So if we actually cash, and some companies still do this, we actually have cash and checks coming into our place of business. We'll have a couple people in the mailroom. We have cameras set up for controls, but we have a couple people. One person will be charged with cash, and the other person will be charged with remittances. The cash will go to the bank, deposited, and the remittances, of course, will go to accounts receivable. Other approaches that we can use that might be a little bit better than having a cash come to our place of business. Lockbox, where in that case it's goes to a post office box, makes it, which the post office box is owned by the bank. The bank picks up those checks and deposits them into the company's account. Electronic lockbooks, similar, except for that we're going to electronically send that information about the customer to us, to the company, immediately. EFT, that's when you use your electronic banking. And then EDI is where we have not only the banking is done electronically, but also the invoicing is done electronically. All right. ERP improvements, technology improvements. So real-time order. We have real-time order, and we can detect it immediately. If there's any errors, we can detect those immediately. POS systems, for instance. Credit approval can be made at time of sale. Inventory records, of course, are updated as soon as the sale is made. Warehouse and shipping can better plan activities, minimize time required to fill customer orders, and they're going to be using technology like RFID and barcode technology so they can update things more accurately and quickly. We can compare data from shipping with sales order data. So shipping data with sales order data, those should reconcile. If there's a difference, and we can find out what the reason is pretty quickly. Maybe there was a back order, so it may be something legitimate. Cash receipts are processed more quickly. Reports are timelier. All right, let's talk a little bit about control objectives in the revenue cycle. Threats in each of these areas. So sales order, we have some threats. Incomplete or inaccurate customers. Incomplete or inaccurate customers. Orders have to call customers to get correct information. Credit sales to customers with poor credit. Legitimacy of orders, so they're not, it looks like some of these orders are maybe through post office boxes, so they're not real. Stock outs, carrying costs and markdowns. Lost sales, excess inventory, so that means more carrying costs and markdowns. All right, so for incomplete or inaccurate customers, we want to have a good database that's up to date. Credit sales customers with poor credit, that we want to have technology that will tell us that if a customer is overdue, that we're not going to be able to add any debt to his account. Okay, but we want to have a separate credit area, or separate functions credit from sales, a separate credit area where we don't sell product to customers that have poor credit. Legitimacy of orders, so we want to have controls that and documentation is your friend here, that there should be a valid sales order, there should be a credit check on that customer, there should be a picking ticket for the goods that were sent, there should be a bill of lading. If the goods are sent by a third-party carrier, there should be a bill of lading. So we should have documentation that would help us in ascertaining whether or not those orders are legitimate. Okay, and then stock outs, carrying costs, markdowns, lost sales, excess inventory. We want to avoid having carrying costs. We want to avoid having excessive markdowns, and we do that by having a good, up-to-date inventory control system. Shipping threats. Primary objective of the shipping functions: fill customer orders efficiently and effectively. Talk about some shipping threats. Shipping errors, so we ship to the wrong customer, or we ship the wrong amount. And then theft of inventory, so by employees or in shipment. So for shipping errors, again, documentation is going to be important, and that it's important that we read things closely, that we compare what's on the picking ticket with what's on the packing slip. So picking ticket, what we picked in inventory should equal the amounts that are on those packing slips. All right, so we do that type of reconciliation throughout the process. Theft of inventory, so we want to have cameras, we want to have supervision, we want to do counts of inventory. Anytime someone takes Control of inventory. Anytime someone gets the inventory, anytime someone takes inventory from one party to another, you need to sign off on that and count the inventory. So anytime inventory is moved, it should be counted and someone signed off on. The person that's taking it needs to sign off on it. All right, and the billing and account receivable, failure to bill customer, so we ship but not bill. That really doesn't help our cash flow very much. So we want to have a system in place that as soon as goods are shipped, then the billing will follow suit. So the billing happens immediately. So we need to have some kind of message, email or text message that goes from shipping to billing as soon as those goods are shipped to the customer. And then we need to follow up on that maybe 24 hours or 48 hours later to make sure that they were billed. You don't want to bill them twice because that just kind of annoys customers when you do that. Billing errors, so we have good input controls, and again, reconciliation, we talked earlier, we can compare the sales order with the shipping. So the sales order, the amounts and prices, so forth, should equal the shipping amounts, quantities, and prices. Errors in maintaining customer amounts, accounts, so validity checks, closed loop verification. So if I have a customer number, it should match customer name. Validity checks, so is that a valid customer? So we have a customer number, there should be a valid customer name that comes up with the customer number. All right, then cash collections. When we have theft of cash, you'll have good separation of functions. Handling cash should be somewhat different than posting remittances to the AR. So the person that deposits cash in the bank is not the person that's recording the accounts receivable. Handling checks and authorizing credit memo. So the person handling cash should not then be authorizing a credit memo because they could be giving themselves a credit memo and giving themselves cash. So issuing credit memos and maintaining customer accounts should also be separate. So if I'm maintaining an account receivable account, I'm not the person that's going to authorize that credit memo. Because that's a friend of mine, I can write down his account down to 0. All right, I'm going to skip through the general control issues and get to our problem 12.2. All right, so what inventory control procedure provide protection against following threats? Theft of goods by the shipping dock workers who claim that inventory shortages reflect errors in accounting records. Use cameras so we can see those people stealing our goods from us. Use an automated inventory system like RFID so we're going to be more accurate in updating the inventory. Have receiving reports. And anytime goods come in, fill out a receiving report and should be signed by a supervisor. Posting the sales amount to the wrong customer account because the customer account number was incorrectly keyed into the system. Well, if we put the wrong number in the system, it should give us a name that's not on. So we're updating this customer account balance. I know it's Joe Smith. I put the wrong number in. Joe Smith's name's not going to come up. Bill Jones's name is going to come up. So if I put the right customer number in, the right customer name should come up. That's called a closed loop verification. It's a validity check and compares customer number and name automatically. Making a credit sale to a customer who is already 4 months behind in making payments on his account. All right. So independent credit department, separate from sales. So we should say, the independent credit department is going to say, hey, look, we're not going to give this guy any more credit. But beyond that, if it's 4 months, if it's 4 months behind, you're in a situation now where you're getting ready to write this account off. We don't want to make any more payment. We don't want to give this guy any more credit because we're just going to have to write it off. So that account should be flagged and it should be not allowed to have any more credit. So if he wants to buy something from us, he's going to have to pay cash. All right. Authorizing a credit memo for a sales return when the goods were never actually returned. We want to separate the return area. We have inventory and cash separate. So one person is in charge of inventory, one person is in charge of cash. We don't want someone in charge of both of those because then we can have a sales return that's fraudulent. Writing off a customer's account receivable balance is uncollectible. To conceal the theft or subsequent cash payment from that customer, only managers should be able to write off accounts or to approve those write-offs of accounts. Must be approved by the credit area. All right. So that's our show. I hope you guys have a good week, and I will have a lecture next week for you. So have a good week, and stay safe. So all transactions are authorized. So for instance, sales transaction, if it's a credit transaction has to be authorized. The credit that's going to be granted has to be authorized by the independent credit department. Recorded transactions are valid, that they actually occurred. So we have sales orders, actual sales orders, and sales invoices. We can use data analytics to find whether or not, or detect whether or not those transactions are valid. All valid authorized transactions should be recorded. Saw some of you did the account receivable idea, that there were some customers that said were unallocated. They made their payments, but they were not allocated to any accounts. So that's a situation where the transaction was not recorded. All transactions are recorded accurately, so using input controls are helpful for that. Assets such as cash, inventory, and data are safeguarded from loss or theft, and then business activities are performed efficiently and effectively. So let's look at some